Hey, Sue!
Bev, you're sitting on a monster.
Literally and figuratively. It's my superannuation from Australian Retirement Trust.
Australian Retirement Trust. Right.
Big, isn't it? Comes with an app.
I gotta get me one of those.
One day, I'll unleash it on the world. Maybe even Barbados. Barbados, baby!
Awaken your super with Australian Retirement Trust.
Hi and welcome. My name's Josh Van Gestel. I'm the Senior Manager of Education here at ART, and it's wonderful to have you all back with us. In our last episode, we talked about the importance of contributions in actually setting the foundation of your superannuation, but we also talked about the importance of how they work alongside investments. Two things we acknowledged was firstly that the sooner you start making contributions to your super, the sooner compound interest can start to have an effect that goes for over many decades while you're actually accumulating in your super. But the other thing that we acknowledged was that when you get to the point of your retirement, although contributions are an important part of your final balance, it's actually the investment earnings that you make upon them that really gives you the bulk of your retirement savings. And that's what we're wanting to talk about today. I'm going to be joined by two of our wonderful education specialists who are going to really help us to unpack the investments that we offer, how you can make choice, and also getting a bit of insight into what we're investing in on your behalf. Before we cover all that though, I would first like to make a couple of acknowledgements. The first is to the traditional owners of the lands from which we are broadcasting this event, the Turrbal and Yagara people here in Brisbane. But I'd like to also pay my respects to all of you where you're joining from and the lands on which you are joining from. And I make mention to the Darug Nation in the northwest of Sydney where my life and love reside. What I also acknowledge is that today's presentation is of a general advice nature only. So please consider if there is anything that we cover off that raises questions or concerns, that you have lots of information and options available to you to deepen your understanding, including tools, advice, and other information on our website, all of which we'll unpack for you throughout this session. So importantly, I think before we start thinking about the impact of investments, it's important to consider how we actually feel about money, both now but also into the future. And recent research that we conducted through Australian Retirement Trust of Australians all around the country was to ask them how they felt firstly in confidence about their financial future. In other words, how did they think or feel about their retirement and their funding for it? And what we observed was that only 2 in 5 people actually had a degree of confidence with how they were set up. We also found, though, in this research that a lot of people were uncertain about the short-term impact and considerations on their finances. So very worried about money today, especially as we're seeing markets being so volatile and also seeing an economy that is stretched and that people are somewhat disillusioned by. And these are both important in context of what we're covering today. We are needing to make investment decisions, and I mean us as individuals, in spite of short-term volatility, in spite of concerns we have today, to actually think about bettering our future. And the investment decisions that we make today can have a huge impact on our retirement. And our guest presenters today will actually help us to unpack that and understand that a little bit more. And what I think I'm getting at here is that although we see things that are happening around us, we see things happening with the economy and with markets today, they can make us feel very uncertain. They can give us short-term concern and fear around what's actually happening. But remember that your superannuation is one of the longest term investments that you will ever have. It will be with you for decades to come. Even if you've just entered into retirement, your superannuation may be an investment that you have for 2 or 3 decades. It gives you incredible investment potential. So I'm not saying to ignore the concerns that you have now, but think over the long term when it does come to your super. Now, when it comes to your super, there's a couple of key things to consider. The first is that your super is exposed to investment markets. That means that your super, depending on how you're investing it, could go up or down according to how the share market goes up or down, for example. It could be affected by other parts of the economy, including property. As the market moves, your superannuation will move. And that exposure is important for you to understand, not just that it will have a negative effect at times, but also that it will give you growth opportunity. Exposure to share markets, for example, although it comes with short-term volatility, will give you exposure to long-term growth potential. And again, it's that reminder that I've just been talking about, that your superannuation is a long-term investment. You have the ability to think about not just what it's doing today or this week or this month or this year, or even what it's doing over the last 3 or 5 years, but what it's done over the last 10 or 20 years and what it will do for the decades ahead. But thirdly, and most importantly, whether you're an Australian Retirement Trust member or have your super elsewhere, you have investment choice. You have the ability to change the way that you are invested. You have options available to you that give you access to lots of different assets, a lot of which we'll cover off with you today. So in thinking about some of those assets, though, at a really high level, as I've already mentioned very briefly, you will have a lot of your super invested in what we call traditional assets. These include shares, both here at home as well as internationally. But as I noted, the thing that we realise with shares is, although they give us great long-term potential in terms of growth, they do come with short-term volatility. So traditionally, what super funds have done to try and offset some of this volatility is also given you exposure to things like cash and fixed interest investments. But the thing with cash and fixed interest, especially until quite recently, is that they just haven't provided the investment returns that you, our members, demand and really want to see. Although those investments are more secure in terms of not having as much volatility, they just don't have returns that really keep up with inflation and give you the expectations that you have for higher investments. And so as a large superannuation fund, we've been able to look outside of these traditional areas, although you still have access to them, including thinking about things like infrastructure, property, and what we call private capital, all of which we'll unpack shortly. But the last thing I would leave with you before we hand to one of our education specialists, Pat, is to consider how this all applies to you. I've covered off those assets at a high level, but think about how that looks and feels on your own account balance. And what we've got here is 4 of what we call our diversified or multi-asset investment options. And this is where a large proportion of our members are actually invested. And what you can see is, moving from one side to the other of the screen, is that you can see the asset allocation actually shifts. If you're in our high growth option, you have a lot more exposure to things like shares, property, private capital, things that will have volatility but will have growth potential for them. And on the other extreme, you've got more exposure to those other traditional assets of cash and fixed interest. Means that you'll be more stable in the investment returns, but they won't be as growth orientated. You cannot expect that they will go up as much. This is all what we're going to unpack. And to start us on that, I'd like to hand over to Pat Dunlop, one of our education specialists, with a short video he filmed to inform you around investment considerations.
When it comes to investing, it's important to consider these three aspects of investing. The first one being your time frame. How long do you have to actually invest your money? When it comes to super, a lot of people think, say, 5-10 years is a long time in your investment time frame, but maybe you should be looking at 20, 30, or even 40 years for your time frame. Secondly is your risk tolerance. How do you feel about your risk levels? Do you want to take more risk to potentially get more returns? Or are you more of a safe sort of investor, where maybe you don't want to take that risk, but you want to make sure that your money isn't going backwards for you? The third aspect, of course, are your level of returns. You need to think about what type of asset classes are available and, of course, what types of returns you could expect from those asset classes. So with that in mind, it's important to consider all of the different types of asset classes that consistently make up superannuation investment options. What you can see on screen, firstly, is our cash option. Typically has a lower level of risk, but at the same time, it will have a lower level of expected return. The flip side of that, as you can see, are things like shares, where there is a lot of risk, therefore a lot of potential return. But of course, that could also mean downturns in the investment environment. And that brings us on to the investment emotional roller coaster. A lot of people like the idea of investing. They like that optimism. They put their money into that investment option and they see it start to grow. And with that growth, they get a little bit of excitement and some thrill. And as they see that investment option go right up to its peak, that's when that euphoria kicks in. However, after that, maybe that investment option starts to have a downturn in the market. As it starts to go down, that's when that anxiety kicks in. Once that anxiety kicks in, that's when the denial comes through and that fear starts to ramp up. And as you can see, you start to ride that emotional roller coaster downwards all the way through to despondency. But it's important to point out, a lot of people still think when my investment option is at its absolute lowest, that's potentially the best time to get out of it. Because it's at its lowest, I'm not going to go any lower, but actually that is the maximum financial opportunity you have to actually get some gains on that investment. Because although things will go down, they're always anticipated to go back up as well. So to help you ride that emotional roller coaster, I do encourage you, take your phone, scan the QR code on screen, and this will take you to the risk profile quiz. It'll ask you a series of questions, and what it's trying to determine is what kind of investor you are. Are you someone who likes to take a little bit of risk for those higher returns, or are you a bit more safe? But to get a proper answer to that, use that risk profile quiz and it will show you what kind of investor you are. So maybe you are a growth investor. You understand that the minimum time frame is potentially 7 years for those types of assets that you're invested in, and you would expect to have some sorts of downturns in that period. The flip side of that, maybe you're more defensive. You don't want to take that risk. You just want to make sure that the money you have is safe, but you understand the minimum time frame of someone like that would be closer to 2 years. I encourage you, scan that code, use that risk profile quiz, understand what kind of investor you are, and also understand that the range of returns can vary. What we're looking at on this screen are our investment options, the highest points they've achieved over the last 7 years on a single daily basis. And what we can see here are some fantastic results, especially if we have a look at the balanced index and the high growth option. Now, on a single day over that 7-year period, that looks absolutely fantastic. You'd be absolutely chuffed with those results. However, the flip side of that, these are the absolute lowest points on a single day over that same 7-year time period. For example, if we do take that high growth option, at one point over that 7-year period, it achieved a 30% return, but at the same time on one day, it achieved -9. Can you go through those emotional ups and downs to make sure you get the most out of your money? Because super is a long-term investment. What this graph is showing you is that if you invested $10,000 back on the 31st of December 1999 into our high growth option, although it didn't exist back then, but if it did, where would it be today? And as we can see, over the last 26 years, there have been some significant market volatility actions which have really impacted on your investment. Starting with, of course, 9/11, flowing through to that big downturn, which of course was the GFC and sort of 07, 08. We can also see the impact of COVID there as well. But this is really highlighting that super is a long-term investment. If this person decided not to jump off that investing roller coaster, they kept their $10,000 in that option, even with all these market downturns, they actually would have grown their investments quite significantly. So again, use that profile, find out what kind of investor you are, and make sure you choose the right investment options for you.
Thanks very much for that, Patrick. Really appreciate that insight. So we're going to have a chat about investment options now. Now, this is where the reality of what we're trying to choose actually comes alive. Now, here at Australian Retirement Trust, we've kind of divided our investment options into three sort of sections. The first one is that life cycle lifetime option, and this is where us as a super fund makes the decisions for you. So these options are based on your age and balance. We kind of decide what sort of risk level you should take. If you move over in the middle, you've got that diversified options. This is where you can choose yourself to go into a high growth or a more conservative options. So there are managed options, but you get more control over how your money's invested. The final one here is single sector asset classes. And the unique thing about these is you can choose how much shares or how much bonds, how much international property, whatever you want. So you can make that decision yourself. So essentially it's our choice, it's your choice, or it's your specific individual choice. So you can build it however you want. Now, I often get asked, which option should I go into? And it's really difficult because it really depends on a lot of things. Now, our default option is going to suit a lot of people, and it is our most popular option. But there are a lot of people that want to take more control over that, and that's why we have these other diversified and single sector asset class options available to you. So in regards to which one should you be in, it really just depends what you're trying to achieve, where you are in your life stage. And this is why we've got the default option. So this is the easy set and forget one. Essentially, you don't have to do anything. We'll do it based on our sort of criteria. But so basically what it is you open up an account with ART, you're in the default option, and depending on how old you are, it depends on how we adjust your investments. So they're automatically adjusted throughout your life, with the process being that when you're young and you have a long time before retirement, we have you in a higher growth option. And as you start to get closer to retirement, become a little bit more defensive with your money. That's not necessarily the right thing to do, but it's what we do automatically so that you don't face a huge loss at the end of your retirement or close to retirement, but you still have the ability to get a large amount of growth when you're much, much younger and can afford those ups and downs in the market. Now, this higher growth obviously is around when you're young, and the more defensive as you get older is sort of a way that we've kind of made it so that people can invest and not be too worried about what goes in the market. One of the things that our advisors don't give advice on is try to time the market, and there's a lot of risk that can happen. And when you consider how your investment options should be invested, it's really not a day-to-day sort of investment mix. It's more of a 10, 20, 30, 40-year investment mix. But at any point, you can choose any other option. So you have a lot of choice here about how your money is invested. Now, taking away that default option, we look at our diversified options. And you can see here those bars. This is how much growth assets it has in it versus how much defensive assets it has in it. And you can see here, obviously, the more growth potential, the more growth assets it has, and the more defensive or conservative it is, the more defensive assets it has. So having a look here, we've got all these sorts of asset classes. Now, the first four here, these are actively managed in their risk portfolio. We have balanced risk adjusted, which is a bit of a unique one. The goal of that investment option is to not have that market volatility in it. We have a special one for socially conscious, if you're a bit more environmentally or socially aware in how your money's invested. And the final two are index options. So they're not actively managed, but they still have that diversification, but they're very low fees on it. So all of these options are something that you can consider. Now, if we go to the single sector asset options, you can see here they're basically either growth, defensive, and that unlisted is a mix of both because it doesn't really fit nicely into either one. But you can choose to put 10% of your money into this option, 5% of your money in this option. You really have a lot of choice about how your money is invested. And it really depends on what you're trying to achieve, how long you have to invest, and what your goals are. So for some people, they might have a desire to have a high growth option because they're a little bit further behind. So they might take a bit more risk on in order to have a comfortable retirement later on. Some people might be worried that they might lose some money in the market because they're planning to use it soon. So let's say you're close to retirement and you want to pay out your mortgage. So you might come really defensive with your investments at that point just to make sure you have the capital available for a very near-term cost, essentially. But how you invest really depends on your lifestyle. There is no one size fits all. You should be reviewing your investment options at least every 12 months just to make sure you're still in the right sort of area. But when it comes to investments, Australian Retirement Trust is a really large company. And the reason we're able to invest your money so far and wide is because of that size and scale that we have. So having a look at some of the investment options you have, we've got investments in things like Heathrow Airport in London. We're in caravan parks with G'day Group. We have office buildings down there in Sydney. And we also have, wind farms as well in a lot of different places. So looking at how we diversify your money is quite important. So a lot of people think, I'm going to invest and I want to be in a low risk option. We invest you in so many different options that we believe that diversification gives you a much lower risk outcome. So whilst airports at some point might be doing bad, the turbine farms will be doing good. So they all have different times that they'll be doing well, which kind of balances out the sort of risk that you're taking, the returns that you need throughout your retirement. So it's really important to understand that if you wanted to buy an airport, unfortunately you couldn't. So whilst you could buy into shares on the share market, if you want to buy an airport, they're not for sale, they're not available. The only way you can get exposure to someone like Heathrow Airport is through a company like us. And the same for all these other investment options. We often buy really good quality asset classes and we hold them for a long time. So the time horizon of superannuation, really, if you start when you're 20 years of age, you'll have a super account for 60, 70 years. And that's the sort of investment horizon we look at when we're trying to decide where to put your superannuation. Now, superannuation does need to be looked at over the very long term. So even a 10-year time frame is kind of too short for superannuation. But if we think about the value of $10,000, what does that mean over the long run? So we've got inflation. We know inflation is quite high at the moment, but let's have a look at how $10,000 worked going back to December 2002. So if you were to put your money in a high growth option, yes, there's been some ups and downs over that time. But you can see that high growth option over that 20-year time frame, that 25-odd year time frame, got to $64,092. That's an impressive amount of growth in that sort of time frame. You do need to accept a little bit more volatility to get there though. But if you go onto an option like balance, not as much volatility. So you can see over the long term, they are quite similar graphs, but not quite the outcome at the end. So $57,000 was the outcome. Going down that list there, we've got conservative balance. You can see got to 41 and conservative at 35. And then you've got inflation, which averaged 18%. So you can see all of our investment options handily beat inflation. And there's a bit more of a rough ride for some of those options, but you can see over that sort of time period of 25 years, you can see the outcome that you get. So during that time, a lot of events happened. We obviously had the pandemic, we had the global financial crisis, and you can see them quite clearly on this graph. But you can see over the long run, everything worked out all right, which is why you really need to consider superannuation over the long term, not only for any short-term sort of issues that we might have in the market. Now, that power of compounding returns does make a big difference. So in this example here, you've got a 30-year-old that has $78,000 per year worth of income. They're only receiving employer contributions. They're not making any extra amounts to superannuation. They have 50 grand in their super right now, and they want to retire in 35 years at age 65. Now, what is the difference between getting a 5, a 6, or a 7% return? And believe it or not, it's quite stark. But just think about this, 30-year-old working for the next 35 years on 78 grand, what does that mean for their long-term retirement outcome? So looking here at their balance, you can have a look. Essentially, at a 5% return, they'll get to $400,000. And that's not quite that comfortable lifestyle we might have seen before, but that's still a good amount in their superannuation. You can make a lot of decisions with that. What about a 6% return though? It's only 1% difference, but over 35 years, what does that actually mean for you? You get to $481,000. That's a lot more choice that they get to make. And then a 7% return, even bigger. So almost at $600,000. So you can see the power of those compounding returns really makes a big difference in how you're invested. Now, obviously the higher return, the better off you'll be in the long run, which is why you need to consider when are you actually going to retire and how should you be invested along this journey. Now, some good news here is we do have an app. We also have a calculator that'll essentially do a risk profile for you. So anyone home today, you can actually log into your account and you can get personal advice called robo-advice on which investment option suits you. And that makes a big difference for you in the long run. So jump onto the app and you can log in, you can use that risk profile tool or that online advice, and that'll give you an outcome telling you what sort of investment option you should be considering based on what you're saying right now. And feel free to use this every year. We're not going to change it based on market events. It's really changed based on what you can do in the short term or longer term. So when are you going to spend that money? If you're going to spend that money in 2 years' time, you might consider being more defensive. If you're going to spend that money over the next 30 years of retirement, well, that's when you might consider a medium to high growth option. So from here, I'm going to invite Josh over to the desk. We're going to have a quick break and it'll be me and Josh answering all of your questions.
It's time to wake up and take a look at your super. You could be sitting on a monster. With the latest Australian Retirement Trust app, managing your super is easy. Check your balance, control your contributions, and track how you're invested, all in just a few taps wherever you are. Plus, get notifications and handy tips. Download the new and improved Australian Retirement Trust app today to find out if you're sitting on a monster. Get it now on the App Store and Google Play and see what your super's been up to.
Thanks very much, Steve. Thank you also to Pat. But Steve, good to be on the desk with you. How are you?
Yeah, good, thank you. Good to be here.
That's good. Now, I'll ask you a question without notice. You actually spend a lot of time presenting to financial advisors. Can I ask, what are the most interesting areas around investments that you're actually talking to financial advisors about at the moment, or that you're working with our team on?
Yeah, absolutely. So I guess when we look at financial advisors, they want to know that little bit more. And so something like the Australian share market is quite boring to them. So we really want to dig into what's happening in private real estate, private equities and private credit, because they're a little bit unknown, those sorts of things. So Australian Retirement Trust has a pretty large exposure to some of these private assets compared to other normal funds. And the reason for that is because they're very solid businesses, they're very long-term timeframes, have really good returns. So it's really demystifying how we invested and why we invested in it is what we're mainly talking about.
Well, interestingly, a couple of questions actually to that I might segue to. There's a question here that actually talks around some of those big investments we have, like Heathrow Airport and Discovery Parks you spoke to. How do we actually value those? How regularly are we actually, like it's not like the share market where you can at any moment see where the price is at. How do we look at those?
Yeah, exactly right. When you buy something like an airport, it is really a long-term investment, and it's something that happens, like let's say there's a light that goes out, or it doesn't all of a sudden devalue by $1 million because of that. So these are usually valued every, at least probably every 90 days, every 3 months. We look at, what's the value, what's the long-term outlook for that, and obviously make changes to it as we need to. Now, I will call it out if there is a significant market event, we'll revalue those quite quickly because obviously we don't want any members to be disadvantaged. But every three months or so is when we look at, is this still a good investment? Is it still working well? And we might change the valuation a little bit.
And I think it's important to think about, though, in your update that you talked about, these are assets that we generally will purchase with a long-term view. So even when it thinks about valuing them, that yes, we're wanting to know what's happening as markets may move or conditions change, but really these are assets that we're holding on to as with a longer-term view and reward to them, aren't they?
Yeah, absolutely. We own stuff like aged care facilities and Brisbane Airport. Like we'll probably never sell Brisbane Airport. If your grandson comes into Australian Retirement Trust, they'll own a piece of Brisbane Airport. We'll hold the asset for that long. Right?
And the great thing with something like Brisbane Airport is that it really is, I think it's our chief economist who often says, yeah, you've got to pay more money for a beer when you're there waiting for your flight. But hey, while you're there, have a couple. Those are all ways that it's generating income, that it's the people coming and going, but also what they're purchasing and doing at the airport, the parking, everything else. So really as members, I think the great thing with some of these assets is knowing that they can physically actually move in and out of these assets.
Yeah,
and
absolutely.
interact.
They're super complex businesses, have a lot of yield and a lot of use, and generally like something like an airport or a port, normal port for a boat, there's usually only one in the city. So they are quite well used essentially, and these assets are really prime assets. You can't just buy a second Brisbane airport. You can't just buy, a second Heathrow. You've got to develop those assets bigger and bigger, and they're highly used. So that's why we look at them.
Well, let's maybe move to some of the more traditional assets that we know. A couple of questions that have come in. Firstly, we've got a lot of people who obviously are very interested in shares and very focused on shares. There's been a couple of questions talking about the timing delay. Now, I think some people see the share market moving and think, right, I'll move my super. Just any thoughts around that?
Yeah, so whenever you look at your super account online, usually what you're seeing is the value 2 business days ago, which is why it might not match up with exactly what happened last night because of some news announcement. So there is a bit of a lag between where your money is and when you can see it on your account. So when you want to switch, you usually switch at end of business day, so it's definitely not a live trading account. It's more of a, you can change, and when the investment option strikes its price, we give you that exit price and buy you in at the entry price of the other option. So you will see on your account it's 2 or 3 days behind. It's usually about a day behind really when you're trying to make that switch, but it's not meant for day trading. It's definitely not a share that you can sell at 11:03 p.m. It's not designed for that at all.
Well, to that point, there's been the question about, can I actually choose the shares I'm investing in? Our investment team actually determines the shares that we invest in, don't they? What access do members have around that?
Yeah, correct. We've got a team of professionals who look after all these investment options for you, and I obviously trust them. My money is with Art. When it comes to investing on your own, unfortunately through Australian Retirement Trust, we don't allow direct investment. There are a lot of reasons for this. So, we often talk about this and debate whether we should or whether we shouldn't, but at the moment we think the best way we can serve our members is by having these really simple, easy, cheap to use investments that we have professional guys looking after. And then if you're not happy with the way our managers work, you have index options available to you.
So I'll come to index options, but before I do, I think you're just mentioning cost briefly. There would be a cost if we had a direct share option, for example. There'd be costs associated with that. So that's definitely a consideration. But you've mentioned in your update now again this term index. What's it mean?
Yeah, so an index option, basically the belief is that people try to choose the market. It's really difficult to do so. But if you just buy a little bit of everything, you'll get what the market provides. So it's known as indexing to the market or a passive investment option.
It really tracks the market.
Yeah, spot on. So no one's trying to make a smart decision, and also they're not making dumb decisions either. There's essentially no decisions. You just get what the market returns. And because we're not doing all that extra buying and selling, it means the transaction costs are quite low, because that's where the most costs are when you're having to pay capital gains tax. We have buy-sell spreads, all those sorts of things. Those don't occur essentially because you're just tracking the index. So it is really cheap on fees. So you get the returns with very, very low fees, which is why they work so well.
And that's converse to active, what we call active managed, which is where our investment team is actually looking at where they can actively go into the market and try and make some additional gains, isn't it?
Yeah, exactly right. And we'll call out our investment managers aren't day traders. So they're not looking at trying to get in and out in the same day, which is quite transaction cost heavy. They're looking at the real long term, like should we put more money into this because it's a trend, or it's going to be a long-term benefit to our members. So that's the way our active managers actually work.
So we then, if we move away from shares, probably the things that we always get questions on around can I invest in gold is often topical. And I know that gold's a bit all over the place with everything else at the moment. But we don't offer people the ability to invest directly into different minerals. How else can they think about it?
Yeah, correct. And the reason for that is we talk about passive versus active assets. And I know this is all a bit confusing, but gold doesn't actually get a dividend or a return. It's just a lump of metal. And yes, it changes with inflation. There's all sorts of belief around the value of those minerals. We invest in mining companies. So if you look at our investment options, and anyone can jump on the website and have a look at our top 10 investments. If you look at the Australian share bits, we've got some very big miners at the very top. So because we're getting those miners, they sell that metal, they pay a dividend, they're an actively managed company, they have access to those minerals, but you get a return on it essentially. It's not just the value of what someone will pay you, which is a passive asset versus an active asset.
And it's also got that bit of speculation to it that...
absolutely. Like, it could go up, it could go down, we don't know, but we do know the miner's going to keep digging it up and selling it to people that want it, so we'll get a return.
So it probably leads me in two directions, and it's which one I'm thinking of. But we talk a bit, questions coming around, is there any areas that you don't invest in? You're mentioning miners generally, but what sort of areas do we exclude in investing in?
Yeah, that's right. So as a company, we've made the decision to not invest in things like tobacco, gambling. We've tried to really lower our risk to that. So we wouldn't have any major investments. And there's always this little tiny thing where a company might own a company, but that's not the intent of it. But we really de-risk ourselves in a lot of those controversial things. Uranium mining's another thing. When we look at our social responsible option, that has a few more exclusions on it. So if you go there, you can see some metallurgic coals in there or thermal coals not in there. So you can really get down the rabbit hole as to what we do and don't invest in. Now, this investment philosophy won't suit everyone, and we just need to be aware it is really difficult to make these investment options suit your exact, ethics or values, essentially. So we do exclude a few major things, but it's not always as far as people want to go.
And that's because we're actually investing on behalf of over 2 million people. But it's also that we, as an investor, have to have awareness and be conscious of, even with how we think around moving to carbon neutrality, or how we're actually wanting to make major investment changes well into the future, isn't it?
Yeah, that's right. We have a fiduciary responsibility to our membership, so we do need to look at the long term. So at some point you might see we de-risk ourselves from certain assets classes because they don't have a long-term future. And that's not necessarily an ethical choice, it's just because we know where the money's going, that's where we're going to gradually go to.
And also, maybe it touches on a few areas there. We've talked about speculation, we've talked about ethics, a few other things. This is something you were talking to advisors a lot about a few months ago, but it's really gone off the boil in terms of interest recently, is crypto. We don't offer investments in crypto. How does Australian Retirement Trust actually look at cryptocurrencies though?
Yeah, exactly. So cryptocurrency is what's considered a speculative asset in that it has no intrinsic value. So you can't change it for anything. It has no government backing. Essentially, all it is the hope that someone will pay you more money than what you bought it for. And the reason it's gone quiet, obviously, is because it's not as high as it was. It's dropped by over 50% as at time of recording. So if you bought in at 120,000 and it's now worth 60,000, you're sitting on a huge loss. And that's unfortunately the volatile nature of cryptocurrency. Is right now there's no one willing to pay more than that for it. So when you look at cryptocurrency, all it is, it's digital money, and the blockchain is just a digital ledger of what occurred. We already have digital money, we already have ledgers of what's occurred, so the revolutionary bit behind it is kind of not as revolutionary as people think. It really is just a hope that someone will pay more than what you paid for it.
Thank you very much. And if I can maybe go to a couple of more administrative or questions that people are having about the economy broadly. What I would actually say to you is that we've got a wonderful podcast, Super Insider, where Brian Parker, our chief economist, actually talks a lot about markets, what they're doing, what he foresees, where we've been. So I'd encourage you to think about that. We also have our annual investment update coming up with Anne Fuchs and our chief investment officer, Ian Patrick. But Steve, there's a question here about someone who's quite worried about volatility at the moment, and there's not going to be an easy answer to this, really worried about volatility at the moment, but also wanting to make sure that they drive a strong return. It's very difficult to meet both those masters, isn't it?
Yeah, absolutely. And I guess the thing is to understand you're not alone. Like, as humans, as our nature is, we don't want to lose what we've got. We want to be very protective of that. Unfortunately, just the way the market works, if you're going to accept a return going up, you've got to accept that every now and then you'll have a negative, sort of area. And it's just the way, unfortunately, the market works. You know, hopefully over the long run, you get more ups than downs. Like that's the way they're designed. But what you really need to consider is, should you get advice on this from a financial advisor? Now, a financial advisor will never tell you something based on timing. They'll never go, I think, you know, this area won't work well in 6 months, so you should get out of it. A financial advisor goes, what are you trying to achieve over the long term? And here's how you can invest to ensure you hit that return over the long term. So it's really about thinking, not about the day-to-day volatility or the noise in the media. It's about, how do I get to where I want to be over the long run, and just trust that the market will look after itself. As bad as something is right now, it'll be fine over the longer run.
And you talked about in your update our digital advice tools. So yes, you've got the option of speaking to an advisor, but also we've got a tool that takes you through a risk profile and assessment and actually makes investment recommendation for you that you can go through basically a digital advice process as well, can't you?
Yeah, spot on. That's available to both Australian Retirement Trust and QSuper members, that online advice. It's really easy to do. Takes literally 6 minutes, and it's the exact same questions an advisor would have asked you. So really good outcome. You get a statement of advice telling you which investment option you should choose. So very easy to do.
And it's a great way to also get comfort. I know that I talk about that earlier this year when we saw markets really become volatile, that I personally, for the first time, I've entered my 50s, for the first time I probably got a bit worried about the impact that had on my super. And it was the first time where I actually went through the risk profile tool, and I came to the end of that, and it actually confirmed that where I am invested, although it's got a growth exposure, is exactly where I should be. So it gave me some comfort and confidence in knowing that my investment was right. Steve, probably before we wrap things up, are there any closing thoughts or remarks, even reflecting on some of what Pat talked about? You were talking about that there will be, with any investment, there will be highs and lows, and Pat talked a little bit about the brackets that we see some different investments move within. But any closing thoughts that you give people when it comes to thinking about investing their super?
Yeah, I guess just don't be worried about the short term. You really need to think about superannuation as, even if you retire today, you're not going to spend all that money today. You're going to look at this over the next 20, 30 years. So you really need to be very mature about how you invest your superannuation, knowing there's a long time for you to be able to use that super. So I just say, don't worry about any short-term news. Just make sure you're considering the long term at all points.
Thank you very much, Steve, and thank you all for joining us. We do have a future episode where we talk specifically around thinking around investments as you enter and move into retirement. We understand for a lot of people, when they get to that point of retirement, they do understandably start to think about their investments differently. But to Steve's point, your investment journey hasn't actually ended at that point. You can enter into retirement and still have 20 or even 30 years ahead of you in your investment journey. So we will talk to that. The other thing, though, for you to think about, though, as we wrap up this episode, is we have a lot of information online when it comes to investments. We have our wonderful Take the Wheel program, which are very short, action-orientated videos that help you understand the tools and some of the high-level considerations that you have around different things with your super, whether that be making contributions, thinking about investments, insurance, and other things. It's a great place to start. We also, though, have our podcast series, and our podcasts focus very heavily and understandably, because it's where a lot of interest is, on investments as well as the economy. So some of what Steve talked about today, including our investments in Heathrow Airport, for example, Brisbane Airport, and other investments that we hold, Discovery Parks, there's podcasts that actually do deep dives on that. But we also, as I've already mentioned, have our chief economists make regular updates through the podcast, and soon we will have Ian Patrick, our chief investment officer, also doing an update. So we encourage you to find some confidence in your superannuation, particularly over the long term, as well as the way you're invested, by jumping online and engaging with the information there, as well as through the tools that we offer, and if needed, as Steve outlined, also speak to one of our advice team. But until our next episode, thank you very much for your time. We look forward to seeing you soon.
Hi, I'm Simone Burnett from Australian Retirement Trusts. We've created Take the Wheel, a series of on-demand videos that help you really understand super and take control of your financial future. Over 12 bite-sized episodes hosted by these guys, you'll learn how to grow your super, invest with confidence, protect what matters, and make informed choices. Because your super isn't something that runs quietly in the background, it's your chance to jump in the driver's seat. So don't leave it on autopilot. Awaken your super. Take the wheel today. You never know, you could be sitting on a monster.